Fuzzy Monkey Technologies purchased as a long-term investment $75 million of 8% bonds dated January 1st on January 1st, 2009. Management intends to have the investments available for sale when circumstances warrant. For bonds of similar risk and maturity, the market yield was 10%. The price paid for the bonds was $62 million. Interest is received semi-annually on June 30th and December 31st. Due to changing market conditions, the fair value of the bonds at December 31st, 2009 was $66 million. And we have 4 requirements on this problem. First, we'll prepare the journal entry to record Fuzzy Monkey's investment. Then we'll prepare the journal entry by Fuzzy Monkey to record interest on June 30th at the effective rate. And third, we'll prepare the journal entries by Fuzzy Monkey to record interest on December 31st of 2009 at the effective rate. And finally, we will determine what amount Fuzzy Monkey will report its investment in the December 31st, 2009, or on its balance sheet as of December 31st, 2009, and we'll prepare the entry necessary to achieve this reporting objective. To record the entry on January 1st, we debit investment in bonds at the face value of $75 million, but then we also record a credit using the account discount on bonds payable, and we record that credit for $13 million, therefore bringing the net investment in bonds to the price paid, which was $62 million. So we also have a credit of cash, the consideration given up for the investment of $62 million, and as a result we've got debits totaling $75 million and credits totaling $75 million, and we've recorded the entry on June 1st to record the investment in bonds. Next, we're going to prepare the journal entry by Fuzzy Monkey to record interest on June 30th using the effective rate. Alright, now you see the entry in front of you, and it's given in millions of dollars. There's a debit of cash of $3 million, a debit to discount on bonds investment of $100,000, and a credit of interest revenue of $3.1 million. And on the bottom portion of the screen, I've illustrated how I derived the entries. Okay, keep in mind that on January 1st, 2009, the carrying value of the bonds was $62 million. On January 30th, we receive an interest payment, and the interest payment, as given in Note 1, is $75 million times 8%, that's the stated value of the bonds, divided by 2 since they pay interest semi-annually. So the interest payment we'll receive is $3 million. That's why we have a debit to cash of $3 million. In Note 2, we need to calculate the effective interest income, and we take the carrying value of the bonds, which was $62 million right before we're recording this entry, and we take that times the effective rate, which is 10%, divided by 2 because we're paying interest semi-annually, and that gives us interest income of $3,100,000. The difference between the interest income and the interest payment is the amount of the bond discount amortization that we need to record. Since bond discount shows up as a credit or a contra investment account, then the entry we need to make to record the amortization is to reduce it. So we have a debit of discount on bond investments of $100,000. We have a debit of cash of $3 million, what we received according to the stated rate times the stated value of the contract. And when we add both of those together, we come up with the amount we credit, the interest revenue of $3.1 million. Next, we record the journal entry by Fuzzy Monkey to record interest on June 30th at the effective rate. And in this one, what we see is an entry very similar to the one before it, only now the notes that you see on the bottom of the screen relate to the December 31st, 2009 interest payment. So once again, we're expected to receive $3 million in cash, so we debit cash for $3 million. This time when we calculate the discount on bond investment, we take the carrying value as of June 30th, which was $62,100,000, times 10%, which is the effective interest rate, divided by 2 because interest is being paid semi-annually, or twice a year, and we come up with interest income of $3,105,000. And that's what we credit, although in the middle of the screen you'll see that it was rounded to 2 decimal places and the entries given in millions of dollars. On the bottom I've worked it out to the exact number. Okay, so if I've got a debit of cash of $3 million and a credit to interest income of $3,105,000, then I've got $105,000 of discount on bond investment that we need to debit. And little by little we're reducing the discount and bond investment and increasing the carrying value of the bonds over time. On Part 4, the question asks, at what amount will Fuzzy Monkey report its investment in the December 31st, 2009 balance sheet? Okay, and they're going to record that at $66,000 because that's the market rate given in the problem. Now, when we look to the bottom of the screen, you see that the book value as of December 31st, 2009, or the carrying value of the bonds, is equal to $62,205,000. So we need to record a fair value adjustment. And how we do that is we compare the fair value of the bonds at December 31st, 2009, which is $66 million, to the carrying value of the bonds, which was $62,205,000. And when we do the subtraction, which you see at the bottom of the screen, we come up with a fair market adjustment required to bring the bonds record the bonds up to their new fair value of $66 million. And that difference would be $3,795,000. So we debit an account called fair value adjustment simply because we're using a separate account that gets included with the bond investments. Some folks might record that directly to the bond investment account, but a more reasonable approach would be to use a fair value adjustment account that will show up with the bond investment. So we've got a debit, a fair value adjustment, and a credit to an account called Net Unrealized Holding Gains and Losses -OCI, and OCI stands for Other Comprehensive Income.